Hello friends, welcome again. This is SK Advisory Private Limited. This video is the continuation of the basic knowledge on chart patterns. So let's begin this session. Our first chart pattern is reversal chart pattern. So these are the patterns. The first chart pattern we analyze is the head and shoulders pattern. Head and shoulder is an bearish reversal pattern. It looks like this. As price will be going up after the pattern, it will go down. There are few important elements in the head and shoulders pattern. Head and shoulders which are highlighted by numbers by 1 to 5. The head which is highlighted by number 3. Neckline which is line connecting numbers 2 and 4. Chart pattern we see with this name because the price action appears as a shape of head and shoulders. It is something it makes easy to make you remember to track the pattern in real time. The logic behind the pattern is the price action will make a downward turn by failing production up higher high in number 5 in the price will reach peak in number 3. In the fail attempt to surpass number 3 and 5, all of this means the seller are gaining power and the buyer exhausts their energy. Important thing to pay attention while trading in head and shoulders pattern is the shoulders and the neckline. This is the line which tells you when it breaks out before confirming it. This line also tells you where to enter the market. There are two ways to trade in head and shoulders pattern. Letting price to go below the neckline and wait to price come back and retest this neckline. Some people try to attempt a short trade as soon as the price breaks below the neckline. The problem with that is enter in much less price time and you end up with more risk with a smaller potential. As I said, the idea is to wait the price to touch the neckline as price reaches the neckline, and it is also important to the price is indeed respecting the neckline with its resistance. For example, if price comes back to the neckline and as it reaches it creates a bearish type candle, you can think about going a short trade. This is just an example. Of course, there are thousand different things can happen if price comes back to the neckline to be tested. So in summary, there are mainly two ways entering a trade using head and shoulders pattern. You can wait price to close below the neckline and use that to trigger a trade, which is more danger, or you can wait price to close below the neckline and come back to retest it, also observing how price reacts as it reaches the neckline. It is certainly possible if price close below the neckline and it starts to rise again completely disrespect the neckline. That's why it is important to enter at more precious place, and it is possible to be less risky at the entry. You need a logical stop loss and a logical target. Those depends on the entry you choose. The logical stop loss should be at high number 5 as price breaks below the neckline. High number 5 will become the supply zone where sellers confirm their power. Next in line we have reverse head and shoulder pattern. It works in a similar way standing head and shoulder pattern. The reverse head is a bullish reversal pattern where standby version is bearish reversal pattern. The reversal head and shoulder pattern has the same configuration as standard, which is upside down. We have a lower flow to higher high. The logic behind that is seller will be able to create a low in number 3. At the last they can create a lower low in number 5. The pattern is confirmed when the price breaks the neckline. As we have already stated, it can be horizontal or slope depending where the highs and lows are located. The safer entry happens when price be tracked back to the neckline after breaking a bullet, and the optimal and logical stop loss has to be placed below the number 5. That happens because the price breaks the neckline. Number 5 will be confirmed the down zone, which will protect your stop loss order in much cases, not also though. The target of the trade as big as 3 times more than the stop, you can take a risk like that to serve trading in a long trade. Next in line, we have a bullish reversal chart pattern called double bottom. As the name suggests, it forms two lows as the same price. It is a bullish reversal pattern. So price will be going down. Then the double bottom will appear. The signal to reversal to the upside. The double bottom is confirmed when the breakout line come out of number 2. It is a broke to the upside. The logic behind this pattern lies again in a simple mechanism in a higher high and a lower low appears in the chart. Double bottom means that there are two lows hitting the same level, and that means the second low failed to go below the first one. This is a sign of weakness to the seller because they were not able to surpass the last line they create for self. If price is able to break high in between these two lows, it means buyers are gaining power over the sellers. So not only sellers fail to create a lower low or buyers will be able to break the last level, sellers come from this breakout line is high in between these two lows, so it can be only horizontal line. There are two ways to trade a double bottom pattern is to wait for the price to break above the line and come back to retest its support, just like we saw previously. The price trace back to the breakout line. If it does, you can enter a long trade with the stop below number 1 and number 3. As per logical stop loss order, as price breaks out above the line, it creates a demand zone over number 3. So that zone works as a caution for protect zone to your stop. It doesn't always work, of course. By this you avoid your chance in stop loss. The target should be at least 3 times as big as the stop loss size. Once you stop and take profit, targets are set. You should not move them. You should leave it to hit your target or your stop loss. And the rest all graph we will discuss in our upcoming sessions. So thank you for watching. Goodbye.